One thing that's really kind of impacting deals getting done outside just the financing are the increases in taxes and specifically on insurance as well. Insurance costs went up almost 30% for landlords year over year. Insurance is one of the largest expenses outside of payroll and outside of taxes of a deal. And that can really swing a deal from working with great returns for your investors to almost killing the deal entirely.
Welcome, everyone, back to the podcast. As always, I'm incredibly excited today to host and have as our guest the one and only Nathan Loy. Welcome, Nathan.
Thanks, Ravi.
Nathan, if you don't know already, is a Senior Acquisitions Analyst and involved in the special operations at Viking. He is really the brain of Viking, the one that knows the markets, the economy, the geographic regions that we're involved in, and whether any deal passes first muster and should be brought to our acquisitions team. So we're very excited to have Nathan here today, and we're going to talk about the market. Are we planning to have or go into a recession, or is this going to be a soft landing? Viking just did a webinar with John Chang, the Marcus and Millichap Economic Advisor. Phenomenal webinar. If you haven't already, please listen to that because there's a lot of good data in that webinar. And we're going to be talking about some of the same themes in this podcast. So if you listen to that, you'll have a more robust understanding, but we're going to also dive into it. So Nathan, let's start with multifamily demand and how is it holding up in light of the economic uncertainty and recession concerns?
Yeah, absolutely. I love that we're diving into the market because you can go high level at a national, scope. We can dive into specific markets, and we'll probably do that throughout the entire conversation. But speaking of demand, it's always that balance, right, between supply and demand. And what we saw, especially during COVID and during the pandemic, was we had a ton of demand into new markets, right? Traditionally, it was just the major MSAs, just the major cities. But during that COVID time, we saw a lot of expansion out to what we call secondary and tertiary markets. And so with that, you saw a lot of supply come to those markets as well, right? The new construction kind of engine or train, if you will, was kind of trekking behind all the demand. And now what we've started to see is demand is still incredibly strong for multifamily, but it's starting to taper in some specific markets. But that demand is still there, right? On a national level, we're still are, the last report I read was around 4.5 million units that need to be delivered over the next 10 years or so to really kind of keep up with that demand. And part of that is the cost of purchasing a home and the cost of owning a home has kind of shot through the roof in recent months. So just for those kind of data nerds out there like me, the 30-year mortgage rate was up almost 18% year over year in Q2. And, home ownership costs are around $760 higher than they were on average just a year ago. So that keeps demand on the multifamily side of things because it forces people to be renters, especially those that were kind of stored up cash during the pandemic and had a bunch of what we call dry powder, essentially available cash on the sides. With those rising costs of home ownership, some people are starting to not jump into home ownership as kind of as readily as people might have thought of a year, 2 years ago during kind of the pandemic boom.
Yeah, and interestingly, in recorded history, this is, I believe, the highest discrepancy. This time is where there's a highest discrepancy between price of home ownership and price of renting. Mm-hmm. And there's an excellent graph. Unfortunately, I don't have it in front of me. And you probably know which one I'm referencing, Nathan. But you can look at the price discrepancy, and there's like a back and forth, year over year. But when as we're approaching 2023, you notice that the price of home ownership escalates tremendously, almost exponentially compared to the price of renting. So there is still a very strong demand for renting. People can't afford homes, and the price of homes isn't projected to go down at all. When you consider many of the economic analysts out there, the ones that are in the know, the talking heads out there, group all their opinions together, and they all are in consensus that home prices are not going to drop. And I live in the Northern Virginia area. Home prices are quite expensive here. At one point, we saw a very mild dip when we hit we're post-pandemic, when interest rates start really shooting up. But prices have continued to stabilize or increase where I'm living. And I really find that where I'm living in this area is a good microcosm for the national feel and sense. It just seems to work that way. Whenever they say, there's a dip, and I see a little bit of a dip, and there's a rise, we see the rise. I was actually, in fact, talking to one of the real estate agents in my community, and I was asking her what she thought about the market, and she corroborated exactly that. Like, post-pandemic, there was a little dip and there was a slowdown, but now in my neighborhood, for example, people just are having multiple offers on homes, and some homes, that the super expensive ones, are not being transacted on because they just think maybe they've overshot. So I'm seeing like the very expensive ones where maybe there's not as much of a demand for, but the standard American home, certainly demand. Awesome. All right. So moving on to the next question, Nathan, which markets do you see the strongest growth in rents and occupancy rates in 2023, and which ones are cooling off?
Yeah, absolutely. So we're still seeing really strong rents throughout, the Sun Belt markets like Phoenix, Atlanta, Austin, the DFW area. So those markets that saw kind of huge rent growth throughout the pandemic are now seeing kind of sharper inflections when it comes to stabilizing back to a norm. So during the pandemic, we had double-digit rent growth where some markets saw 12, 15% rent growth. We're just not seeing that anymore. It's tapered down kind of to the single digits again, which, if most of you guys know, but before kind of the pandemic, the rule of thumb, at least on the underwriting front, was to underwrite 3% rent growth every year that you hold the property, which for most markets is adequate and is a fair assessment. Obviously, during the pandemic, we saw crazy rent growth that shot through the roof, but it's tough to underwrite that same rent growth moving forward because you have that recalibration of the supply coming to the market, the demand tampering a little bit, and people kind of adjusting to that post kind of pandemic lifestyle. So other markets like San Francisco and New York that were kind of at the top of the headlines that saw kind of a mass exodus almost of people leaving the states. They're starting to see a more gradual rent growth stabilization, and we're seeing the same thing in the Midwest markets too. Those Midwest markets don't tend to have the same peaks and valleys as kind of that Sun Belt or those coastal markets do, but they produce relatively consistent and pretty strong returns. So we're seeing that as well. On another note, vacancy is also quite substantially higher than it was even a year ago. It's almost 2% higher on a national level, and that can kind of it gives you kind of a peek behind the current into that rebalance of supply and demand. Where during the pandemic, everybody was moving out and there just wasn't enough homes or units available for all that increased demand. Now, as the construction starts to get underway, we'll probably dive into new construction a little bit, but as that new supply starts to come to the market, it's expected and it's normal to see greater vacancy even in those markets that have high demand.
Yeah. So what we're seeing when we analyze different MSAs in Viking, we're seeing a massive correction in areas like Phoenix, like Austin, where the cap rates were hitting 3%. And the market has shifted with the debt prices going higher, the economic slowdown, market shifted tremendously. So, up to 200 basis point shift in cap rates in Phoenix. Whereas when you go to secondary, tertiary markets that weren't as affected by the cap rate compression during the boom, they are seeing, maybe a 50 basis point increase in pricing. So, Atlanta, we're maybe 50 to 100 basis point increase in pricing. So we are seeing some of the reflection there in terms of the value of these multifamily properties. So remember, when you increase the cap rates, the price of the property decreases. So we are seeing some of that, but there is still growth. We're seeing a pretty stable rent growth in a lot of areas. And you really have to look at the microcosms, right? You don't look at the macro when you're looking to purchase a place. You really have to look at that particular area. And there's certainly some areas out there where you can get a 10% per year rent growth, especially when you have a value add business plan that you're implementing, you can see a 10% year-over-year rent growth. There's some areas that are going to be maybe flat or maybe even negative. You really have to look in detail in that particular area, do market analysis, and that's what we do at Viking. We really focus on the areas we know, and we do a very tight analysis and understand where that market is and where it's going. But in general, that's what we are seeing. Cap rate increases. We are seeing slow off in demand, but there's still demand currently, and rents are still increasing, but not as much as before. And vacancy is also normalizing. As Nathan, you mentioned, there was a higher vacancy, and things are kind of tightening up a little bit right now. We're seeing about a 5.3% vacancy rate nationally, and which is historically right where it should be. If you look at historical trends, 5% is where multifamily should sit, and that's where it is. So things are sort of normalizing now. Okay, so let's move on to, you mentioned construction. How's construction impacting multifamily vacancy rates and pricing?
Yeah. So new construction is pretty much, I'm not going to say the only way, but I'd say a very large contributor to how new supply comes into the market, right? So if you're looking at that demand and supply imbalance, it's also important to focus on the supply side of things. So what kind of new units are coming to the market? And they're not spread equally across all the states. So there's a record 400,000 units that were forecasted to be delivered this year in 2023, which is the most kind of new construction that we've seen since the 1980s. So that wave of new construction and new supply is really concentrated on the Sun Belt, again, predominantly because of the demand that we saw there. The thing about new construction that you have to keep in mind is that it takes at least 12 months, if not more, to, site plan, to go through all the legalities, to actually build the apartment complex. So new construction in some sense is always kind of a lagging indicator, if you will, right? Because even if you have everything planned out, that new supply isn't really hitting the market till 12, 18 months out. And that's if everything goes to plan. So naturally, as that new supply comes into the market, it might not be at the same demand level that was that initiated the onset of that new construction. Does that make sense? So that new construction is obviously going to push up vacancies and will kind of limit rent growth. Right now, we're sitting between kind of 2 to 3% nationally for rent growth. But the good news is that about 200,000 units have been delivered in the first half of 2023. So we're on track to meet that kind of 400K marker, which is up, over 50% year over year. The problem is that new construction, and specifically the debt that you can get on new construction, is still pretty expensive. So it's limiting the amount of new supply that can actually come to the market because the labor costs, the supply shortages, we're still seeing inflation not being tapered down all the way to the Fed's kind of 2% mark, and you have expensive debt. It just makes it very challenging right now to start new construction outside of the next kind of couple of years until the debt side of things gets back into equilibrium, just like the supply and demand side of things.
Yeah, absolutely. So we're seeing a tapering of construction, but new units are coming online because several years ago when these construction projects were being planned, debt was cheap. They were able to underwrite a higher cost because of the debt. Now things have changed. At Viking, we are not looking at new construction deals at the moment, but we're not opposed to it. We may start looking at that soon. We do try to buy newer assets in general because there is still a considerable upside in some of these assets. There is still potentially a value add plan in some of the assets. Like the one in particular I'm thinking of is a deal that we're about to close on in the South Bend, Indiana area. It's a relatively new build, 2018. There is still some upside in terms of value add, and there's still some rent growth, and it's a newer asset, and it's just easier to manage. There's less maintenance issues, things of that sort. So we're shifting our focus to those types of assets as well. So something to consider when you're looking at different types of investments. Many of the more seasoned syndication companies are doing as we are doing, shifting towards newer assets. It's just more stable, less risky, and something you want to think about when you are investing in a particular property. Okay, so now let's shift to amenities, tenants. What are they looking for in multifamily properties? What's hot right now? Because all I hear is pickleball. That's everyone's talking about pickleball. Is that the thing, Nathan? Is that what
Right? Believe it or not, scrap all multifamily, just move into pickleball and you'll be absolutely fine. No, I'm just kidding with you. It's funny the kind of rise of pickleball. It's interesting because it used to be tennis courts. I'm seeing a lot of properties now that had tennis courts that are being repurposed into pickleball courts, and a lot has to do with that kind of older kind of baby boomer population that is cognizant of their needs, if you will, right? And they don't want all the running around that tennis offers. So pickleball actually is a pretty hot amenity right now, especially for the communities that have families and that have kind of that older population. Other amenities that are really kind of hot on the market right now are on-site gyms, specifically those that have kind of an outdoor component to that gym, some sort of outdoor lifestyle center, outdoor lounge seating, pet amenities like dog washes, especially during the pandemic. I can talk with multiple people who have picked up kind of a furry friend during the pandemic, and they want a place where they can go out to a nice cured dog park. They can go out for they can wash their dog there. And then the tech component is also huge, right? To have charging stations, to have smart technology, to have access to who you let in, package lockers, for example, all of that kind of convenience has really become hot over the last year or so, and I expect it to continue moving forward too.
Yeah. Yeah, just a couple of thoughts. When we started buying properties, we looked at mostly 80s properties, and every one of them had these massive tennis courts. It just went with the times. When McEnroe was playing, everybody was huge and like trashing their rackets and playing outside in these tennis courts. And then we converted them all to sport courts. But now a lot of people are just converting them to pickleball courts. It's really interesting how times change things.
Mm-hmm.
So we're doing the same. We've got sports courts / pickleball courts, like these other outdoor amenities. One thing of note, as those of you who know me know that I'm very into green technology and energy conservation. So on our properties, we are changing thermostats, we're changing locks. Thermostats, obviously adjust as the tenant comes and goes. So there's some energy savings there. We're also in one particular property that we have, we're actually putting solar on the roof. We're doing a solar battery, and we've changed all the thermostats so that the tenants have access to it. But there's zero cost doing this. There's so many incentives and programs out there. It's amazing. We got this all for no upfront cost. And if any of you are listening to this and want to learn more about how to get these incentives, reach out to us because we're happy to talk about this. Many of our projects, the thermostats, for example, will fall under a credit where we can potentially offset the cost of that. So it's a tenant amenity. People appreciate it. It decreases the use of resources, and it's a win-win for everyone. Okay, so let's talk about asset classes within multifamily, like student or affordable housing. Which ones are attracting the most development here?
Yeah, from a development standpoint, I definitely say that the affordable focus, especially from Fannie Mae and Freddie Mac, is prevalent last year. It's been prevalent for a few years now, and it will continue to be prevalent moving forward, especially with that discrepancy of home ownership versus renters. The government and kind of the financing that is attached to the government, i.e. Fannie and Freddie, they're very focused on providing an affordable option for families. So we're seeing a lot of what's considered LIHTC or LURA deals. I can get into specifics, but essentially what that means is for offering some sort of affordability component, whether it's an income restriction or a rent restriction, then you get kind of tax credits or some sort of other abatement that helps you on the expense side of things. So those are pretty popular right now, especially, again, with the housing shortage. The same thing affects the affordable kind of demographic, but that type of demographic isn't as mobile as kind of what you call a B-class tenant or an A-class tenant. So they're really kind of focused on providing an affordable component there. Second kind of factor, like a sector of multifamily that's really picked up speed lately is, as you said, Ravi, the student housing side of things. That took a real dip, kind of like retail and office did during the pandemic, because most of the student housing became virtual or just wasn't as attractive given the uncertainty that was going on in the economy. Now there's a little bit more uncertainty and people are moving back into office spaces, moving back to, on-site, living on campuses or at least around campuses. We're seeing a huge uptick in rent growth and in kind of vacancy reduction on the student housing side of things too.
Yeah. And as far as affordable housing, we don't do affordable deals in Viking. We're not against it, but we just haven't found any that makes sense to us. But if you do come across some that have these tax incentives, some of them can be a game changer. I mean, there's a one particular syndicator that works, it's based in California. There's a lot of deals in Houston, Texas. They had a relationship with the local municipality where they got a significant tax write-off, and it just it caused crazy increases in their pro forma expectations. So if you come across something like this, pay attention to it, look into it, see what kind of tax incentives there are. It could be really worth an investment. Student housing, I agree, Nathan, completely. Like student housing is back. It really took a hit for a while, but now it's back. So it's something else to consider. Again, Viking, we don't do those types of projects, but something to look at. Let's talk about markets again. Let's jump to certain markets that may be risky for newer projects. So say an investor is interested in investing in a new asset, like we just discussed recently. What are markets that maybe they should think twice about because maybe there's an oversupply?
Yeah. So from a long-term perspective, multifamily is still strong. The demand's still there. Supply is still kind of lagging demand, which is all great for growth. However, that being said, there are markets that, again, kind of what I stated at the beginning of the talk, where there were markets that saw an oversupply of construction where demand tapered a lot faster than was expected, and you still had that new construction come to the market, even though that the demand had shifted elsewhere. So some of the markets like Nashville, Austin, Phoenix, there are some short-term risks, at least, given that supply could outpace demand. Those markets have construction pipelines that are over 4% of the existing inventory, meaning if you took all of the apartments in one of those major cities, the new construction was 4% greater than that current existing inventory. And that's not a hard or steadfast rule, but it's kind of a benchmark to say, hey, there might be a little bit too much supply. There's tremendous growth, but as we're seeing, the rent growth is slowing in some markets, valuations are dropping in some markets.
What should it be, Nathan? What should that number be?
4% is fair, but I'd like to see closer to the 2 to 3%. So you're still seeing steady supply come to the market, but there isn't this huge influx because that influx is what creates that risk, right? If you have a steady supply and you can taper back maybe from a 3% to a 2%, it's a lot more easier to manage those pipelines. Whereas if you have kind of a rush of that new supply that came that was really chasing all that demand, that's really what creates that oversupply. And then that's where you start to see larger vacancies. That's where you see larger rent growth declines, asset prices decline, all that. But again, it's only in the short term for the next kind of 3 years-ish. So those markets still need that supply. It's just a matter of timing at that point.
Yeah, I was thinking of a particular experience in DC. I own a few smaller properties in DC, and there was an influx of new product back. I think it was pre-pandemic, and we saw a tremendous drop in interest in our particular properties. Rent dropped considerably. There was a high vacancy in some of these newer units, and they were offering all these incentives. So the tenants obviously went there and took advantage of those incentives, but that hit pretty much everyone else across the board. So this is certainly something to pay attention to when you're looking at investing in a particular area. In DC, things eventually stabilized because the amount of product decreased. And the good part about DC is that there is a barrier to build, and they restrict the height of buildings in certain areas, actually in all of DC, but even more so in certain areas. They restrict the amount of a new product in DC in certain areas. So, we're now that everyone has recalibrated, things are evened out, but it took a while. It took a couple of years. So, that's always something to consider when you're investing in a new market. And that's something to ask the sponsor, what do they think about the absorption rate, the new construction, and how it affects pricing? Another MSA we invest in a lot is Atlanta, and Atlanta has a significant barrier to entry in construction. There's really not a lot of stuff going on there versus Dallas Fort Worth, which has no barrier or very little barrier, and there's a lot of construction there. There's also a lot of demand because people are moving from California and other areas to Dallas Fort Worth, but that's just something to absolutely consider. Okay, so let us talk about the outlook on multifamily fundamentals. So now that we are seeing, the economy stabilizing in some degree, how has the fundamentals shifted over the course of 2023, and how's the economy involved?
Yeah, absolutely. So to your point, Ravi, it is almost kind of a recalibration, one of expectations, but two, kind of that supply and demand imbalance, and then three on the debt side of things too. So demographics and housing trends are still strong, and they still kind of underpin long-term growth, but I expect to see some recalibration in kind of the short term. So again, going back to some data for those who wandered on that, because really that's what gives you kind of the most informed decision is following the data rather than just having kind of a gut reaction. The gut reaction can help for sure on certain assessments, but when you're looking at national levels when it comes to debt or supply and demand, data is what you're going to want to follow. So from a data perspective, national rent growth was 1% in Q2, right? That's expanding across all markets. Those that saw incredible rent growth and that saw negative rent growth. And that was down from the 15% at kind of the peak during the pandemic. So again, that 15% is not to be expected moving forward. So naturally, after you typically have a seasonality of really high rent growth, you typically have a seasonality then of a recalibration and a lot lower rent growth too. We're seeing that those Class C properties had the highest rent growth of almost 9% year over year, which actually outpaced the Class A and Class B segments. And the way that I kind of rationalized that was during the pandemic movement, those demographics that were shifting around, those that had tech jobs and high income jobs were able to move pretty readily. And that was what caused that demand in certain markets. Those that were in that C-class demographic didn't have that same, again, mobility or kind of margin of error, if you will, in their rents. So now we're seeing the A and B class still be strong, but now C class is starting to kind of catch up with the rest of the demand that the other two sectors filled. One thing that's really kind of impacting deals getting done outside just the financing are the increases in taxes and specifically in insurance as well. Insurance costs went up almost 30% for landlords year over year. And, insurance is one of the largest expenses outside of payroll and outside of taxes of a deal. And that can really swing a deal from working with great returns for your investors to almost killing the deal entirely. So it's important, we at Viking always get an insurance quote even before bidding on a property, just so that we're absolutely, I'm not going to say absolutely sure because no one's absolutely sure what the insurance is going to be, but just so that you're minimizing the risk before actually offering on a property. Because the worst thing you want is to offer on a property, then get the insurance code, and then have to, back out of a deal. So not surprisingly, given the debt environment, given the rising costs of insurance, and given the rising costs of payroll too, we're seeing that demand on the workforce side of things. It takes a lot more now to retain certain employees because they have that optionality of moving or going to a different spot, especially with the job growth that we recently saw coming out of the pandemic too. But the number of transactions was down almost 63% year over year in Q2 of 2023. So that, again, from my perspective, it's mainly on the debt side of things that just, it's tough now for buyers to pay for deals for what sellers want to part their deals for, given what the costs of debt are and given the cost that, interest rates may still continue to potentially rise in the future, or at least not go down until probably 2024, 2025. So to your point, Ravi, we were talking with John Chang not too long ago. He was saying that there was a lot of deals that happened, I'd say probably 6 to 10 months ago, where people got things under contract, but because the interest rate and the debt environment was moving so quickly, by the time they actually closed on the property, their financing looked completely different than it was at the very onset of it. So they had to pull out or renegotiate, and that really kind of halts a lot of transactions. And then again, you have a lot of dry powder from the institutional side of things. Pretty much most REITs right now are sitting on the side and are just kind of waiting for the right opportunity. Because over half of the sector right now is on the private side of things, and it's those private landlords or private operators that are really kind of having it scrappy, getting creative to make deals work in this environment.
Yeah, there's a opportunity here as well, because the institutions, as you mentioned, the REITs, they are sitting on the sidelines. Many of them are pencils down, not underwriting, because they want to make sure there's stability, and there's certain stability that's quarter over quarter in the debt markets. So when they underwrite a deal, they're not underwriting maybe too conservative or too aggressively, and rates change, and then they're not able to get the returns that they project. So many of these institutions are sitting on the sidelines. That leaves a lot of open space for syndicators like us that have the ability to adjust and be nimble, and look at one-off transactions and see if they make sense. For example, the same deal that I just mentioned earlier in South Bend, we're getting that at a 6 cap, and it's a 2018 asset. It's a beautiful property at an amazing cap rate, and we're assuming a loan that's 3%, incredible positive leverage. But institutions aren't really bidding on this because they're pencils down. And the reason we got it at such an amazing price is because we don't have that pressure of institutional buyers. So this is a great opportunity to buy, and just you have to really understand the market, understand what you're looking at, know and trust your sponsor. So great opportunity to buy the right deals. I would also recommend that you be very careful with Class C assets. As you mentioned, Class C has been increasing, but the Class C properties house tenants that are the working class tenants, and unfortunately, these folks are the first fired, last hired type, and that's kind of like the saying that goes around with Class C properties. But these folks, are oftentimes put in a tough situation. They just can't pay rents in their property. So there's a massive bad debt situation that builds up year over year. And that's why sometimes Class C gives great returns, because you're taking a risk. So that's something just to consider when you're investing. And Nathan, as you mentioned, insurance, big deal, huge deal. If you see a deal where the sponsor's not underwriting a 20% increase in insurance year over year, then question that, because we're seeing crazy insurance rate increases, especially in areas like Houston and like in Florida, even areas that are more inland like Atlanta. We're seeing higher rate increases, not as much as those other areas, but certainly in areas that are affected by weather, huge increases. Okay, so last question, Nathan. How resilient would you say the multifamily asset class is compared to office or retail?
Short answer is I still think it's one of the most resilient asset classes, especially during those periods of recession. You're going to have some near-term choppiness and some uncertainty in the next year and a half. But I think those fundamentals are still, underpinning the strength of multifamily and the returns that it can provide at the right kind of, risk-adjusted profile, right? Ultimately, investments are always kind of a gauge of a risk to reward, right? Because everything has risk. Stepping outside and walking your dog has a risk to it, right? But there's a reward that outweighs it. So I think multifamily out of most of the asset classes, given the stability, given the the housing shortage that we have, there's going to be some corrections for sure in the next 12 to 24 months. But I'm still fully under the conviction that multifamily is a strong investment class. And don't get me wrong, there's other investment classes out there that are strong and could potentially produce higher returns too. But again, it's about that risk to reward balance.
That's the right answer, Nathan, because we are a multifamily syndication company. So if you said anything differently, I'd be concerned. You gave the right answer, but it's funny. I was speaking with a retail syndicator, and I asked him, what's the best asset class? And he said, the best risk-adjusted asset class is retail. And I was like, of course it is, because that's what you do. So everybody that does, as an expertise in any particular asset class is going to tell you that theirs is the best. The reason I personally like multifamily to try to stay away from, just my natural bias doing what I do is really because the understanding that people need a place to live. And you look at the pandemic, how it affected retail, it was a huge dip. Like some of these properties went under, office went under, industrial actually did fairly well. And that was surprising to a lot of folks that, it continues to do well. But multifamily is stable. It has, the people need a place to live. It's protected by the government in terms of the debt. There's agency debt, Fannie and Freddie debt that we can acquire with multifamily real estate. And it's a non-recourse loan, meaning that if it were to fail, for example, they wouldn't come after our personal assets. Now there's these bad debt, bad investor carve-outs, bad boy carve-outs is what they call it. So if you do something like fraud, obviously you're going to get pulled in, but like, as long as you operate as you should, then you're protected because it's a non-recourse loan. Versus retail, it's a recourse loan. So if you lose that retail space, the lender can come after you personally and take your assets. So that's another reason I like multifamily, because it's more safe in that way. You're not putting yourself at risk, whereas some retail people obviously are, or most of them are, but they also have higher returns because of it. So if you see something with crazy high returns, if there's like a retail deal or office deal or something like that, then just think twice about it, and understand that you're getting those higher returns because of risk. Like Class C multifamily, you're getting those higher returns because of the risk you're taking. Just one last point, I invested in this hemp deal, and the returns when they underwrote them were like, they said they were so high they couldn't even underwrite it. They're like, you're going to get like 100x return. And I was like, oh man, I'm all in. This was like many years ago. I'm like, I'm all in, put some money in there. I haven't gotten one distribution from that investment. And I may lose my entire investment, which is, okay, it's fine. I mean, you got to experiment a little bit here and there. But I think back and I'm like, if it's too good to be true, it's probably too good to be true.
Mm-hmm.
And that's the same for any type of investment. But again, multifamily is safer in that way.
Yeah. And it multifamily offers like an inherent diversification that I don't think a lot of other asset classes do. So when you think like even 100-unit multifamily, that's 100 individual tenants or 100 individual families that make up your revenue stream. Unlike office or retail, typically most kind of retail or office spaces, you have one large, maybe two large tenants that make up the majority of your revenue. Call it 60-70%, and then you kind of fill the other spaces with some smaller retail or some smaller office. So if that one tenant, if you will, moves out or doesn't do well financially and has to close down shop, you're pretty much immediately at 60% vacancy, 70% vacancy. And then you just don't see that in multifamily because you have that diversification. Even if, vacancy slips, you typically have, again, other families, other individuals that are still continuing to support your revenue stream. And you have a new tenant to pull from pretty readily, right? Because it is a need, right? Unlike retail, where you don't necessarily need a new shirt or new shoes. I mean, don't get me wrong, depending on who you talk to, maybe, but people are always going to need a place to live. So people will choose a place of housing over, a new retail shopping kind of buying spree.
Right. So, one thing we didn't really answer, Nathan, is a soft landing versus a recession. What's in the future? What are we seeing?
I would expect we're going to see a soft landing. I think the Fed's doing a really good, diligent, and poignant job of keeping us out of that recession-like environment. The economy is still strong. It's mainly just the interest and the debt that we're seeing. So debt was super, super cheap. And so you saw a lot of spending. So you saw this boom of economy. Now the Fed's tapering that demand with increasing interest rates. And they're pretty steadfast. Powell's pretty steadfast on keeping his 2% inflation marker, and that they're going to continue to raise rates until we hit that benchmark. So again, historically, we've never seen a soft landing. It typically doesn't happen. And that very well could be the case if we do see recession, I think it's gonna be kind of like a recession light almost, where it's not gonna be a typical recession that then moves into depression, like our worst fears and the world's burning down. I don't think that's in the works for the foreseeable future.
Yeah, the fundamentals of the economy are strong, and this comes from many economic analysts. And once again, we referenced this John Chang webinar because it was so good in so many ways, and there was a lot of information that he shared with our investor and listener base. But what many people agree is that this may be a situation where there is a soft landing. You really just want to pay attention to the standard market indicators. You want to look at inflation. You want to look at the consumer price index. You just want to make sure that the sentiment is there, because if the consumer sentiment drops, there's higher inflation, there's other issues that come up, then you may want to, or there's the unemployment numbers increase, those are signs where you consider a recession. But the way things are proceeding currently, it looks like it could in fact be a soft landing. So that's, crossing your fingers, that's what we're all hoping for. And that pretty much wraps it up. So thank you, Nathan, for all your incisive and thought out answers to these questions, because it is very complicated and there's a lot going on. But as you all can ascertain, Nathan is just a fountain of knowledge, and we really appreciate him being on the team at Viking. And he really allows us to pursue properties that make a ton of sense because we've analyzed it in so many different. So thank you for listening, everyone. Thanks, Nathan, and hope you tune in for the next episode.
Awesome. Thanks, Ravi.